What if the advice you've been following for the last 10 years is only half right? Not wrong, half right. For 12 videos, I've made the case for pensions, the tax relief, the adjusted net income reduction, the compounding, the 60% effective relief for those in the taper band. That case is solid, and I stand behind every word of it. But there is a question that most pension advocates never ask. A question that becomes important once your contributions reach a certain level, or once your income does. When does a pension stop being your best option? Because it isn't infinitely efficient. It has limits that most people who contribute to one have never been shown. My name is Mark. This is the video that completes the pension picture. Limit 1. The annual allowance. Up to £60,000 per year or 100% of your earnings, whichever is lower. Employer contributions count towards this. Once you've reached the annual allowance, including carry forward, the pension is closed for the current tax year. Limit 2. The tapered annual allowance. If your adjusted income exceeds £260,000, your allowance reduces. At the extreme, it falls to £10,000. At that point, the pension is still useful, but your capacity to contribute efficiently is substantially constrained. Limit 3. The access age. You cannot access pension savings before 55 currently, rising to 57 in April 2028. For someone planning to retire or significantly reduce income before that age, pension money isn't just deferred, it's locked. ISA money bridges that gap. But the ISA has its own annual limit of £20,000. Limit 4. Withdrawal tax. 25% of the pension comes out tax-free. The rest is taxable income on withdrawal. If your pension pot is very large relative to your other income, if drawing from it pushes you into higher tax bands in retirement, the efficient tax rate on money going in versus coming out can erode significantly. These aren't reasons not to use the pension. They're reasons to understand where it fits in a broader structure. Once the pension is maximized, there is still income to structure. Here is the order of what comes next. First, overflow. ISA. £20,000 per year. Tax-free growth, tax-free withdrawals, accessible at any age. The ISA is the natural complement to the pension for every pound above the annual allowance. Use it fully before anything else. Second overflow. Spouse or partner's ISA and pension. If your partner has unused ISA or pension allowance, income-producing assets can be structured jointly. Their ISA allowance is an additional £20,000. Their pension annual allowance, if they are earning, is an additional £60,000. A couple with both allowances maximised has £160,000 of annual tax-advantaged capacity combined. Third overflow. Venture capital trusts. VCTs offer 30% income tax relief on investments up to £200,000 per year. Dividends within a VCT are tax-free. Growth is CGT-free. The investment must be held 5 years. Higher risk and illiquid, appropriate only for those with a solid conventional base already in place. Fourth overflow. General investment account. Once all tax-advantaged wrappers are full, a GIA is the default. No relief on the way in, no shelter on growth or income, but accessible, flexible, not subject to pension rules. Strategy. Hold growth assets, not income assets. Use the annual CGT exemption. Move assets into the ISA each year where possible. The pension is the foundation. The ISA is the structure built on top. Everything beyond that is the overflow. The order matters. The wrappers matter. There is a proposed change to pension inheritance rules in April 2027 that anyone with a substantial pension pot needs to understand. Currently, undrawn pension pots fall outside the estate for inheritance tax purposes. That makes pensions exceptionally efficient for passing wealth to the next generation. From April 2027, under current proposals, undrawn pension pots will be brought into the inheritance tax calculation. Pension inheritance. Proposed change April 2027. Currently, undrawn pension outside estate for IHT. From April 2027, proposed, undrawn pension within estate for IHT. IHT rate 40% on estates above the nil rate band. This does not eliminate the pension's advantages during your working life, but it changes the estate planning picture significantly. If you have a large pension pot, professional advice is warranted before 2027. The question, should I contribute to a pension, is almost always yes. But the more useful question is, how much, in what form, and then what? The pension is a brilliant vehicle. It is not the only vehicle, and it is not infinitely scalable. Knowing its limits is not a reason to use it less, it's a reason to build around it intelligently, so that every pound of income above the allowance and below it ends up somewhere efficient. That is not tax avoidance, that is financial architecture, and it is exactly what this channel was built to explain. If you're approaching or have reached the pension annual allowance, 3 things to review. 1. Confirm your available allowance, including carry forward. If you have unused allowance from the past 3 years and your income supports it, deploying it this year is one of the most tax-efficient single decisions you can make. 2. Confirm your partner's ISA and pension position. Combined, a couple's tax-advantaged capacity is substantial. Using it fully across both is the most efficient structure before moving to overflow options. 3. If you're considering VCTs or EIS, make sure the conventional base is already solid. These are not replacements for pension and ISA, they are additions for income above what those wrappers can absorb. The optimal stack above the annual allowance: 1. Pension to annual allowance, including carry forward. 2. Spouse or partner pension to their allowance. 3. Your ISA, £20,000. 4. Spouse or partner ISA, £20,000. 5. VCTs with risk tolerance and solid existing base. 6. EIS, higher risk, 50% relief, longer lock-in. 7. General investment account, managed for CGT efficiency, in that order, every year. In the next video, the full picture. How to think about income, structure and tax between £100,000 and £200,000. Not year by year, but across an entire working life. 13 videos in, 2 to go. Subscribe. The final 2 are the ones that make the whole series make sense. See you in the next one.